The Tobin's Q approach, popularized by Nobel laureate economist James Tobin, is a valuation metric that links a company's financial market value to its real physical assets. The core idea is that the financial market's valuation of a company should, in the long run, be equal to the cost of replacing that company's assets. This approach has significant implications for understanding investment decisions, firm value, and the broader economy. 1. The core concept. At its heart, Tobin's Q is a ratio. Q equals frac text market value, OF, the firm text replacement cost, OF its assets. The numerator, market value of the firm, is the combined market value of the company's equity, its stock, and its liabilities, its debt. The denominator, replacement cost of its assets, is the cost of buying all the physical assets that the company currently owns. The theory suggests that, in an efficient market, the ratio should tend toward 1.0. This is because, if Q greater than 1, the market values the company more than the cost of replacing its assets. This implies that the company is earning a rate of return higher than its cost of capital. In this scenario, it is more profitable for a company to acquire existing assets by issuing new stock, since the market values the new stock highly, than to build new ones from scratch. This high Q value encourages investment, as new capital can be acquired at a market value greater than its replacement cost, leading to economic profit. This also attracts new competitors to the market. If Q less than 1, the market values the company less than the cost of replacing its assets. This suggests that the company's assets are not being used to generate a sufficient rate of return, or the market has low confidence in the company's future prospects. In this case, it is cheaper for a person or another firm to buy the existing company on the stock market than it is to build a new one from scratch. This discourages new investment and can lead to mergers and acquisitions, as well as firms selling off assets. 2. Calculation and practical challenges. The theoretical calculation of Tobin's Q is straightforward, but in practice, it is very difficult to obtain the precise values. Numerator, market value of the firm. This is calculated as the market capitalization of the company's stock plus the market value of its debt. While market capitalization is easy to find, the market value of a company's debt is often not readily available, as most corporate debt is not publicly traded. Analysts often use the book value of debt as an approximation, which can be a significant limitation. Denominator, replacement cost of assets. This is the most challenging part of the calculation. The replacement cost of a firm's assets is almost impossible to determine with accuracy. It would require an appraisal of every piece of equipment, building, and land, taking into account current market prices. For this reason, practitioners often use the book value of a company's total assets as an approximation. While this is a common workaround, it is a significant departure from the original theory and introduces a major source of potential error. 3. Implications and applications. The Tobin's Q approach has several important implications for economics and finance. Investment decisions. The theory provides a powerful framework for understanding a firm's investment decisions. A high Q ratio acts as a signal to the firm that the market is ready for more capital investment. This suggests that firms with high Q values will tend to invest more in new plant and equipment, while those with low Q values will cut back on investment. Firm valuation. Tobin's Q can be used as a valuation tool. A company with a Q ratio significantly greater than the first of may be considered overvalued, while a Q ratio less than the first of may suggest it is undervalued. This can be particularly useful for identifying companies that have significant intangible assets or growth opportunities that are not reflected on their balance sheets. Intangible assets. A high Q ratio can be an indicator of a company's intangible assets. Things like brand recognition, patents, intellectual property, and strong management are not typically recorded on a balance sheet but are valued by the market. A high Q ratio suggests that the market is recognizing and valuing these unrecorded assets. Macroeconomics. At a macroeconomic level, a high average Tobin's Q for an entire economy or a specific sector can indicate a strong appetite for new investment and future economic growth. 4. Limitations and criticisms. Despite its theoretical elegance, the Tobin's Q approach has several limitations and has faced criticism. Measurement problems. As discussed above, the difficulty in accurately measuring the replacement cost of assets and the market value of debt is a major drawback. The use of book values as a proxy can lead to misleading results, as book values may not reflect the true economic value of assets. Assumptions. The theory assumes that the firm's stock price reflects all available information and is a perfect measure of its future prospects. However, stock prices can be influenced by market speculation, investor sentiment, and other short-term factors that are not directly related to the value of the underlying assets. Static versus dynamic. The model is somewhat static. It doesn't fully account for the dynamic nature of a firm's operations, such as changes in technology, market conditions, or competitive landscapes, which can significantly alter a firm's value over time. Doesn't explain performance. A high Q ratio doesn't necessarily mean a firm is performing well. It could simply be that the market has high expectations for the firm's future growth, which may or may not materialize. Conversely, a low Q ratio doesn't mean the firm is a bad investment. It could be a sign of an undervalued company. In conclusion, the Tobin's Q approach offers a valuable and insightful framework for understanding the link between financial markets and real investment. While its practical application is limited by measurement challenges, the core idea that the ratio of a company's market value to its replacement cost is a key driver of investment remains a fundamental concept in economics and corporate finance.